So the S&P is down by over 7% in the last few weeks, and investors are wondering where the rock bottom is. So let's start with the first source. This is the impact of tariffs and DOGE initiatives on the GDP. So this is a chart developed by Apollo Global Management, by the chief economist of this firm. And I have to say that when I first saw this estimation on the very first chart of the report, I was sold off to read everything. So a very interesting report. I recommend you to have a complete look at it, because it will give you a full understanding of what's going on. It's, I guess the easiest way to interpret the chart is by looking at the red line. That's the total, or the sum of the different shocks to the GDP forecast. And the red line is showing a trend that is quite negative in 2025. So they expect GDP to be below the current forecast over the next 4 quarters. In other words, they're saying that the current forecast is too optimistic, and the real value is going to be below. Again, I really don't care about the figures. 0.5%, 0.3, 0.8, who knows? Nobody knows. All I care is the trend. So over the next 4 quarters, GDP is going to go down. From Q4 25 onwards, it seems that the positive effects from the cost-cutting measures and the tariffs are going to start to kick off. And that's why in the short term, and again, to me, short term is end of 2025, I am bearish on the US economy, but that doesn't mean that I am bearish in 2026. And I believe we will see the chart. I will try to look at. I will be honest. And I'm really sorry to say this word. Technical analysis, like that. And I will try to look at that and understand where there is a support, where the price can bounce. There are, in my view, if you can use valuation analysis, you can use whatever you want, but I've seen technical analysis to work quite well when it comes to the S&P. In any case, we're not trading here. We're looking at weekly charts, since the 80s. So this is not, let me see the 1 minute chart on the S&P 500 and see how can I buy deep out of the money puts. No, 0 DT. No. Right, so we have the first chart. Q4 25, that's when this model is expecting the tariffs and the DOGE initiatives, or at least to stop pressuring the GDP. Great. So the next chart is even more interesting. So this is the impact of tariffs and DOGE initiatives on inflation. And again, I don't care about the values because it's really difficult to measure the impact. But what I care about is the actual trend. And you can see it until Q4 25. Inflation is expected to go up, to go above that forecasted baseline. So the baseline is here. In other words, what the economists are currently believing, that's how inflation is going to look like. And their model says, you're wrong. It's actually going to be higher. Yeah, I'm higher by this much. So again, I care about the trend, Q4 25. After that, things cool off. Yeah, so it's interesting. It's interesting. We have already two different factors, inflation and GDP. And it seems that end of 25, things are going to improve. But up until then, things are not really favorable. So I won't go into all the details. I believe there should be a presentation by them somewhere. I don't know, maybe you're going to have to pay for that. I got no clue. I just look at this PDF, and to be honest, it was amazing on those two charts. Let's have a look on this slide right here with the tariff timeline, because if you believe, well, you probably know this, that there are more tariffs to come, but exactly how many more? And they summarized everything here. You see what I mean? I mean, these guys are geniuses. 4th of February, that was the tariff on China, the 10%, nothing. Canada and Mexico, 25%, 10% for Canadian energy, which makes sense considering the imports of oil and nat gas from the country. 12th of March, in 2 days, major exporters. Yeah, so you have 25% of tariffs for all steel and aluminum imports into the US. 2nd of April, very interesting, very important date. I wouldn't short the S&P that day. You know the saying, buy the rumor, sell the news. Yeah, well, this is kind of like inverse. Everyone is expecting the 2nd of April to be really bad. So the share price will decline before the 2nd of April. In other words, it will accommodate that negativity before that. So something to consider. I guess it's going to be a bad day in the S&P, but who knows? 2nd of April, we have 25% on all cars, chips, and pharma. We got all nations in the world. You're going to have reciprocal tariffs. So it's, how do they say it? Tit for tat. And of course, in 2nd of April, you have 25% on all European Union imports. So that's going to be interesting. It's a lot of tariffs to come up in that day. Okay, so moving on. There are a lot of factors in the video that I want to discuss. GDPNow. So we have the Federal Reserve, the Fed of Atlanta. Yeah, they have a metric called GDPNow, which is used to estimate the official BEA GDP annualized return rates in real time. So I guess it's like each 15 days or each it's actually less than 2 weeks. So what we have is the latest data is for March 6th. They estimate the GDP, to be declining by 2.4%. This is huge. We have here a chart, and you can see the GDPNow metric, which again, it's using the same factors, the same mathematical model or a similar mathematical model as the BEA's GDP. But instead of waiting, at the end of each quarter, the official GDP, it's published 1 month after the end of the quarter, and that's called the advanced estimate. And then there are 2 other revisions, 1 month later and then another month later, to make sure all the data is correct and to accommodate all the information and to set on a clear annualized rate for GDP. So GDPNow is saying, okay, fuck that. I want to know the data as of today, as of this moment, and that's where we have the chart. So 28th of February, you have new data from, I think it was the advanced manufacturing. You will see in a chart. Actually, I want to show you now. You can see the track record of the GDPNow metric, and you can see this date, February 28th. You can see a huge inflection point. Yeah, once the model takes into account the M3 data, as well as Q4 GDP, the second revision, and other different data points in regards to the US economy. And you can see that it went from 2.3 on the 26th to negative 1.5. So things are not looking really good on this side. Why? 2 consecutive quarters with negative GDP growth is considered a recession. So that's why the market is a bit, worried about the first, this first estimate on the GDP, is because Q1 most likely will be negative. And the interesting part, if I go back here, in Q1, the only effect on tariffs is the 10% on China. You see, 4th of March, we got Canada, Mexico, we got Europe in April. Q2 is going to be a very interesting quarter, to say the least. And Q2 data is the one that actually makes me nervous. Q1, to be honest, I will be direct. I didn't expect Q1 GDP to be negative. I just didn't, And the fact that it is making me a bit worried. And the fact that you got all these events happening in Q2 things are not looking very positive in the short term. Again, I have a short-term investment time frame. My time frame is usually 3 to 24 months. I very rarely look above that timeline. And again, this is because it's my own style based on my own personal financial situation, which may be different from yours. You may be someone that's wealthy and has a lot of money and couldn't care less about these fluctuations, in which case, amazing, But if you are a poor degenerate, who has to grow his portfolio aggressively, well, you kind of have to look at these things. So something to consider. Let's move on because there is a lot of information that I want to share with you. What you have in blue, that's the blue chip consensus. What the hell is that? You got the top 50 private firms in the US. You have top economists on those firms that are private. So these are individuals that are estimating, again, based on the data that they see, where the actual GDP for Q1 is going. So far, you can see that the decline is not nearly as much as the GDPNow metric. So something to consider, the private sector is more positive than what it may come, which means that these surprises to the expectation, so when you expect this, but you get this, that usually leads to a panic sell-off. Yeah, I'm not saying there's going to be a crash because, just look at the S&P. It's already oversold. Is it oversold? Let's have a quick look on the RSI. It's not oversold. It's close to being oversold. So, that's why I will explain you later on what I did with my portfolio around the sell-off. But right now, today, I'm not considering nearly to short, anything related to the American economy. Like right now, hopefully there will be a pullback. In any case, let's move on. So we have the danger of expectations being, more optimistic than what will probably happen, and next we have the CPI, right? CPI index. This is in regards to inflation. What you see there, let me just zoom in a little bit in the past 10 years. So the Fed believes that 2% inflation makes sense. We're not at 2%. And if I zoom in closely here, since let's say the past year, I believe the increase in CPI, which is the blue line, by the way. So the CPI, if I go to these charts, the CPI takes into account, the changes in the price of a basket of items that you have there. So it includes food at home, energy, electricity, apparel, medical care commodities. You take all that, you look at prices, and you look at how those things vary. So of course, there is something called a core CPI, which is the other line in the chart, and that excludes the food at home. You see the black line? You see how that line is significantly more volatile than the average of all the items? So you don't want to take into account things that are very volatile, because it's going to mess up the data. So that's why the CPI, the core CPI, excludes food and energy. Yeah. So if you go back to the chart, the orange line is the core CPI, which, let's say that it has more momentum, which means it's not going to get affected in the nearer term by the fluctuations in prices. Yeah. So the blue line, again, is the CPI, and since September 24, it has been increasing. I believe it has absolutely nothing to do with tariffs, zero to do with DOGE cost cutting. Actually, DOGE cost cutting initiatives, they really don't go into the CPI, or they don't affect it as much, in my view. They don't affect it as much as the tariff policy from the new administration. So something to keep an eye on is these charts. Why? Because in 2 days, you have the next release, March 12th. So this is going to be a day that you don't want to miss on. Again, I wouldn't trade around the date because there is an expectation for Q1 to go up in regards to inflation. And I believe when shit's gonna hit the fan is gonna be on the second quarter of this year, because that's when you will see the major impact, because you have Canada, Mexico, Europe, the entire freaking world, and all that is only visible from March 4th, I think it is. Yeah, so from between March 4th and April 2nd is when those tariffs they enter into place. Good, let's move on. This is only the second, and I have like 10 tabs to look at. Sticky price consumer, the CPI. Okay, this is the same as, well, it's not the same, but it's similar to the core CPI. Again, this is at 3.6%, significantly above the target, the Fed target of 2%. So something to take into account is that inflation is still high. The sticky inflation is still high, and well. Actually, I wanted to go to the next point, which is the Fed with the interest rates. So the Fed, usually when inflation goes up, interest rates go up. Yeah, because you need to calm people, businesses, you need to calm everyone down. So you have something called the US 2-year bond yields, yeah, which is the benchmark for representing, is the benchmark for investors to understand where the effective Fed interest rate will be, in the next 2 years. But it's an estimation. It's not like it's going to happen. And as you're about to see, this is always, there is a significant lag between this and the actual effective interest rate by the Fed. And that lag, you can see it on this chart. So the blue line, let me make things clearer. 2020, yeah, so we're looking at recent data. The blue line is the effective rate of the Fed. And the green line, this is key. This is that, this 2-year bond yield. So what's this saying? It's saying that when this goes up, it's because the market is anticipating an increase in the interest rate. Have a look at 2022. It was key. Before the Fed decided to increase rates at the beginning of 2022, do you see how this has been increasing? You see how the yield has been going up? And the reason it's been going up is because the market was anticipating an increase in this in the interest rate. So the same happened right here. Let me zoom in. You see the yields goes down before the actual rate goes down. So this is kind of like anticipating those movements. So things are not really favorable since, surprise, February 20th, which is when the S&P began the sell-off. So you can see there, the first red bar there is on Thursday, the 20th of September. So something to consider. Again, sorry, let me go back to that chart. Let's see if I find it, because I have a lot. Something to consider is that the market is anticipating a decrease in the Fed interest rate. And I believe DOGE cost-cutting initiatives play an important part on that. And that's exactly the headline on Bloomberg, which is 500,000 US jobs on the line as the DOGE fallout spreads. I don't think it's going to be 500,000, maybe 300,000. I think Apollo was estimating this in one of the slides. Let's see if I find it. There it is, 300,000 layoffs. That's the consensus for the DOGE initiatives. Something to consider, because when unemployment goes down, the Fed takes action, and the Fed usually lowers the interest rates to stimulate the economy. However, if the tariffs are leading to an increase in inflation, the Fed will have to understand, hang on a second, because if I lower the interest rate whilst inflation goes up, I can actually fuck the economy. So this is one of the things that I actually want to hear from Jay Powell, how he plans to tackle that decline, that possible decline in the interest rate. In fact, if we have a look at this tool, the Fed Watch, Yeah, so we have the consensus on what's going to happen on each Fed FOMC meeting in regards to the rates. So the consensus is that for the meeting on the 19th of March, the interest rate is going to remain the same between 425 and 450 basis points. A decline towards 400 to 425 is quite unlikely. Okay, great. How about for the 7th of May? Well, things are a bit different. So 61%, there is a 61% chance, that the interest rate is going to be the same. But, an interest rate cut is already, anticipated by 37%, with a 37% chance. And if we look at the June 18th meeting, 55%, there is a 55% chance that is going to go down to this range, 400 to 425. So actually, let's continue. Let's go into the future. July, what's the expectation? The expectation now is that the rate is going to be between 375 and 400. And again, here we are going to see the effect of those tariffs and the DOGE initiatives on the economy. So that's why only 7.2%. I believe this is not just a chance. I believe that this is a questionnaire for different people on what they believe, the interest rate will go. So it's only 7% of people that believe it's going to stay the same. Most people think the rate is going to come down. And if we move on to the 17th of September, there is a 37% chance that it's going to be below 400. Now, here, going to December 25, people expect this to be in the 350s. And of course, moving on to next year, I don't know, this is not really accurate because so many things can happen. But yeah, people expect this to cool off in this range, 350 to 375. Yeah, so if we move on to July, for example, July 26, they believe it's going to go down, but this is not necessarily accurate. So yeah, that's the expectation, 350 to 375. I think it's reasonable for the effective interest rate. Great. Now moving on to the next factor, we have the job cuts. So I already mentioned before that I believe there were 500,000 predicted for, I think it was just this year alone. And data from different private companies is already showing that the job cuts announcements for the month of February are already at the same level as in 2020. So yeah, something to consider. And that's the reason why the market is anticipating a decline in the effective interest rates, in the Fed's effective interest rate. Great. So what's the next point I wanted to cover? We got, so the sticky CPI and the flexible CPI is very similar to what I already discussed before. So the sticky CPI includes items that are not easily influenced by changes in prices like food or energy. And the flexible CPI, it's more sensitive to those things. And since September, there has been an increase. I believe that can be just noise because we're not seeing the effects of those tariffs so far. And we won't be seeing them once the March 12th data is released. Those effects will be visible in Q2. And I'm really not really sure when the Q2 data is going to be released. It's usually maybe a few days after the end. So that's going to be probably for, well, we'll see. We'll see. I will have to check that in July, but not sure exactly when. In terms of the unemployment rate, this is quite interesting because since mid-23, the year-over-year trend has been negative, which means that unemployment has been ticking up in the States. Again, this is unemployment in the cities and not considering the farming sector, so things that are not in the cities. Jobs that are not related to those. So the month-over-month change, even though it was positive, to January, it's a decline from the previous year. So that was one of the reasons why last week many people talked about the unemployment increasing in the States, and they were worried about the DOGE initiatives. However, I think that data is only going to show up in the next month. That's when you will see the actual spike in unemployment. I think I had a chart here. This is the civilian unemployment rate, and you can see this is the total number of unemployed, or the percentage of unemployed people in the US as of the total population. And this has been increasing significantly since 23. Well, not significantly, but you can notice that the trend is not particularly encouraging since mid 23. Next, we have different results from polls. So this is the United States News-Based Economic Policy Uncertainty Index. You can see a spike in the results. So uncertainty is increasing around the tariffs, and I believe that's why we're seeing the panic sell-off in the past 2 weeks in the SPY, in the S&P 500, which is the same. And the volatility, as measured by the VIX, things look quite interesting, because since that Friday or that Thursday, February 20th, the VIX is up by 77%. So this measures that volatility in the S&P. And the trend is not particularly encouraging, because it seems that, things are approaching those levels as in 2022. And as you know, 2022, how much was the actual sell-off? Let's see exactly. 25%. Not a lot, but yeah, something to consider. Great. Let's see, what is the next? So this is the GDP. As I said before, the GDPNow is anticipating a decline in Q1, and 2 consecutive declines in the GDP is what the economists consider as a recession. So Q1 is most likely going to be negative, and Q2, I believe because of the tariffs and the DOGE initiatives, I believe there is a chance for that to be negative as well. So I will keep an eye on the GDPNow metric from the Atlanta's Fed to understand how that looks like for the second quarter of this year. This is actually the schedule. So GDP, the release for the first quarter is on the 30th of April. So yeah, something interesting to keep an eye on, because this is the official BEA release, and GDPNow is just an estimation from the Atlanta Fed. So the actual value that you have to keep an eye on is this one right here, not this one. This one is just an estimate, the GDPNow. Great. So I think I covered mostly the points that I wanted to discuss. This is just an overview of the market. I think it's quite interesting, because year to date, well, let's have a look. Microcap, it's down by 10% year to date. It's quite usual, because the volatility there is higher than in the S&P. And that's why most of the companies that I shorted in the last week, they belong to this category, because, usually when the economy doesn't go well, microcap stocks, they tend to sell off for obvious reasons related to risk. When it comes to the US equity sectors, there has been a significant sell-off this year in the technology and the consumer discretionary sectors, down 6 and 8% respectively. And over the past month, there are only 3 sectors that have stayed above 0% growth. So that's the consumer staples, what a surprise, healthcare, and real estate. And the ones that took the biggest hit was the technology and the consumer discretionary. And again, this is probably related to that possible decline in GDP, because consumer spending, as shown in this chart, plays a very important role in the GDP figure. So if consumer spending is affected by different factors, then GDP is probably going to take a hit. So something to keep an eye on. And I think, yeah, that's what I wanted to cover mainly in the video. I think now for the end is going to be an estimation on where I believe will be the rock bottom of the sell-off. So we've seen already 2022. We've seen that the S&P declined by about 25%, which, fair enough. If we extrapolate that to 2025, 25% is approximately below 480. So 480 seems to be a support, So this could be a good target for a rock bottom. And again, I anticipate this to touch the line, and I anticipate a huge bull run after that. Of course, there are many factors that you have to consider before buying the dip, or significantly, especially if you decide to short some of these equities. But 480 seems to be a target that's, in my view, reasonable enough for a rock bottom in the sell-off. And I think that's it. In the next videos, I will try to provide more details on what stocks I actually shorted and the rationale behind that. And also, I will provide the rationale on why I liquidated my 2 portfolios on March 4th, which was it on the green line? Yeah, no, it was not. It was not on a green day. It was on a red day. So that's bad according to investors, but who knows? Who cares? Because the S&P is actually down by 3% since then. So that was a good decision, especially because I owned a lot of speculative stuff. Great. So I'll see you in the next one.